Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles VinodSrinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog / newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about, or rather continuing to dissect, what has been going on in global markets. The market has rebounded as of late, and as I speak today, the market is not doing so bad. And it seems to be that the panic has now faded and things have gotten back to normal. But as we talked about yesterday, there are still certain parts of what happened that need to be broken down, and we need to look at whether this is going to be an ongoing trend or whether this is going to be just one little panic day which the market suffered from, which has now been overcome, and we're going to go back to normal.
More than normal, what we were before.
Yeah, what we were before. So, first of all, the market's going back. Nifty 50 has only gone up by about half a percentage point as of when we're talking today. And over the past 5 days, it has gone down by 2.86%. So, the Nifty is not anywhere where it was before. It's still down. And if you look at the Japanese Nikkei 225 index, it has gone up by 8.59% as of the time of talking, or rather as of the time of recording this video. However, over the past 5 days, the Nikkei is still down by over 10.36% because the drop was quite a huge drop, and just a mere gain of 9.5% from the lower amount isn't going to reach back to where we were before.
Correct.
So this is an important point. The markets are not where they were before. They're still down, and it has a long way to go if it wants to go back to where
And if you really want to see it, you should break it down to individual shares. Shares you've been investing into, shares you've been buying into. Take one individually and look at it granularly, and you'll really understand how the market is really not back where it was.
Yeah. And we talked about a tech sell-off a while ago. We looked at companies such as Nvidia and Alphabet not doing so well. And Japanese companies especially, some of them went down by 17-18%. And what seems to us, which didn't strike us then, was the fact that this could penetrate the rest of the market, or that the rest of the market would follow suit. So what has triggered all of this? Where did it start? Let's go back in time. Let's go back to last week, Thursday, when the manufacturing ISM report and the unemployment report, which came on Friday in the US, basically together said that, look, the economy isn't growing as fast as it was before, and the job growth isn't enough to keep unemployment rates down. And basically, the unemployment rate in the US creeped up just a little bit on the margin. And this was enough to basically signal to investors that the market may, that the economy may be cooling down, and therefore a lot of investors who were holding on to a lot of risk. If you want a breakdown on how to handle risk, please watch Howard Marks' video. But just a short summary is the fact that when there's a lot of risk which you're carrying for very minimal returns, you're bound to lose a lot of money because you're not taking on the kind of returns you should be getting for the amount of risk you take up.
True.
So a lot of market investors and traders have realized, or had realized, that maybe they took on too much risk and decided to move down the spectrum a little bit. Because if you looked at the spread between high yielding junk bonds and treasuries, the spread was very narrow, about 3%.
Yes, it's very strange.
In the US market, because they were trying to lock in higher returns, and people thought that soft landing and no one's going to default. But now a risk of default has risen. I don't know by how much it has risen, because you can't put this in numbers. But
it's just a feeling.
Yeah, the numbers.
Sentiment.
Yeah, there's an indication, there's an angle that it may be going, it may be changing in direction. I don't know by how much it's changing in this direction, but there seems to be information telling us that maybe the economy can go in this direction. And if it does go in this direction, you have to account for this information. And what ends up happening is that people are on the higher end of the risk spectrum suddenly wake up and realize, wait, I'm taking on too much risk for the amount of return which I'm getting. I need to move out of where I am. And that's what we're seeing with the spreads between high yielding corporate junk bonds and treasury securities going up.
Correct, widening.
Yeah, widening. Because people are moving from high risk to lower risk, and that pushes down.
So that means junk bonds now will have to offer higher interest rates to attract investors. So what he's trying to say is, before people were willing to take garbage for the same rate as something as gold, now investors have realized this is gold, boss. I cannot expect you to not me to take gold. If you want me to take your crap, you have to give me more money for this. So this is what was like this is slowly becoming like this. So that means if you want the investor to move away from something solid as gold and come to you, you have to offer him something which is outlandish. And that's what Sashwath is trying to say.
Right. And it's not just one direction, it's bidirectional, because the safer asset is also lowering in yield because people are coming into it in droves. So that being said, the spread is increasing. We've made that point. Now, what happened on Friday? What happened on Monday? Let's take a look. Friday, the markets panicked. The US markets especially panicked. And we saw the Nasdaq and the S&P 500 and the Dow Jones, whichever index you believe to be the one to look at, all of the indices fell in unison. And over Saturday, Sunday, we got some possibly notable news that Warren Buffett has been selling Apple, and he sold by about half a stake was sold. And we got information on Monday that Japanese markets fell by about 15-20%. And then all this information led to people panicking on Monday. And then there's a huge sell-off in the US, because remember, the US is behind on time. So what happens in Asia is going to affect sentiments abroad. And what we end up seeing is that there is one main theory, the carry trade. The fact that people are borrowing in the yen and investing in countries like Mexico and Brazil, because both these countries have very high yielding bonds.
Correct.
And something which points, we don't have hard data on the fact of whether people are now coming back and paying off the yen debt, but we do have indications. Again, these are indications. The indication is that Brazilian and Mexican bonds have been going up in yield now, which is telling us that people who borrowed in yen and put money into this, if they did do that, which is very common in the arbitrage way of trading, it tells us that people are now taking money out. We don't know whether they're taking money out because it's the flight from risk to safety, or whether this is because of the yen's appreciation in value. But one thing is for certain, people are taking their money out. And that is something which is undeniable. So this is happening simultaneously. And while this happens, then the question becomes, why is the S&P 500 falling? The S&P 500 is falling because of the fact that the Magnificent Seven are a little towards the riskier side of things, because these are companies which do not have inelastic products. During a recession, people are not going to be buying Tesla cars. People are not going to be, let's say, giving...
Or even taking cloud subscriptions.
Yeah, and Meta and Alphabet are solely on advertising revenue, and they're not going to be paying you advertising revenue if the economy
because people will immediately want to downgrade their Netflix subscriptions, their Hulu subscriptions. People think of downgrading their cloud. Let's say they've been outlandish, taking clouds here and there and everywhere. They'll think of sizing it all down, trimming everywhere, because people will look at their monthly statement and see where is all the money going.
This is the first thing any rational, logical human being is going to take out of their expenses.
Because they'll see this is not necessary anymore.
And for Alphabet and Meta, Facebook, which are powered by ad revenue, obviously they're not going to do so well during a recession, if there is a recession, because who's going to advertise when the economy is not doing so well? So these are the cases to why these companies are the first on the chopping block. And then if you actually look at the S&P 500's performance sector-wise, consumer staples, the companies which are recession-proof, utilities, which again, you will need water, you will need electricity. These are things you will need. Real estate, you need a place to live. Healthcare, you do need to get your things treated, your ailments. So these are the sectors that have relatively outperformed things like consumer discretionary, which is basically your luxury vehicles, luxury goods, all those things, and your information technology companies, your Alphabets and your Metas, and the general energy sector, which is more towards the industrial side. And if there is not much industrial activity, there's not much need for energy. So these are the sectors that are getting hit compared to stuff like consumer staples and healthcare.
True.
So what does this tell us? This tells us that people are pricing in a recession. People are now believing, or rather the market, when I say people, I mean the market. The market believes, or seems to believe that a recession is on the cards. And interestingly enough, there's something known as the VIX index, which tells us how much you have to pay to have a short-term hedge on the S&P 500, which is
Correct.
basically insurance. It's an insurance for the S&P 500. The VIX goes up when the S&P 500 goes down. That's what the VIX is. And the thing is, the VIX went up by a crazy amount. And what it seems to me today, that I don't think just Warren Buffett liking cash right now or Asian markets having an unwind is really cause for such a panic. I think what it tells me is the fact that people believe that this is going to trigger a chain effect. And if a chain effect truly starts occurring, where because someone in Japan decided to sell somewhere in the US, or because Japanese sentiment has infected US sentiment, and people around, even if you have a solid position, if tomorrow the market falls by 10% because people are scared, now your position will come winding down, because even though now you're in a solid position, if people are scared and they lose out and they have to sell on margin calls, that basically is a cascading effect where it basically also affects you. And your so-called strong position today may become a weaker position. And this anticipation may have led people to start selling and taking on insurance for their portfolios.
The problem is people have been buying all kinds of exotic stuff for so long. Most people don't even really have an idea on where their spreads are standing. And the thing with risk is it keeps moving. It's fluid. Risk is never stable. So today, what looks like a very good, solid scaffolding, matter of days can change and turn into something very shaky. And as an investor, if you're not keeping an eye on it, it's very difficult to know where it's moving. It's like standing on liquid lava, as you want to take an analogy. Because if you fall off the scaffolding, you get toasted as soon as you hit that lava. So this kind of panic is there in the market. And it's primed very well to this point where anything and everything, a small informative news like what Shastri was saying, talking about unemployment rate just ticking up slightly, has created such a huge panic. To the point, we had traders and investors and so-called leading luminaries yesterday on various media platforms in the US asking Fed to quickly intervene and give an emergency rate cut. It was that crazy, the panic in the market. And the Fed said they're not doing anything like that. They said, sorry, this is not our problem. And the panic has seemed to have died down, kind of like dampened. But the thing is, when such a news can create such a panic, it can, when there's some real cause for alarm, like what's happening in the Middle East, anything can push this beyond panic, where we cannot calm the markets down. To the point where some investors who have been there for a very long time saying, even if the Fed at that point of time steps in and starts cutting rate drastically, it may not be enough to calm the market. So that is the situation we are in, and how this is going to play out, I really don't.
And I think this entire rate cut dialogue has become a placebo, in fact.
Yes.
Because I don't think a 0.25 rate cut is going to change anything.
No.
In the sense that it's going to be a placebo which pacifies you and makes you feel okay and gives you a false sense of security. But on the ground level, on if the economy is going to start performing miraculously better, I don't see how that's going to happen, because I feel like it's going to be a drop in the bucket or drop in an ocean to see a 0.25 rate cut suddenly change the economy's trajectory and maybe lead the economy into a softer position. But that being said, I still have to say, like what I said in the video yesterday with my other uncle, the game is still afoot and we don't know what's going to happen. This may create new sense of confidence in the market that, look, we batted off. We were able to take one on
shake this off,
take one on the chin and keep investing and keep pushing the market to new highs. Or if there's going to be the starting point of a false sense of bravado and then we're going to see a fall. Because let's remember the fact that during a slowing economy, an overpriced market doesn't need any particular reason to fall one day.
Yes.
And in a strengthening economy, an underpriced market doesn't need any reason to start climbing one day.
No.
So today, when the economy is clearly visibly slowing down in the US and the rest of the world, I don't see why there needs to be a particular reason for an overpriced market, both in India as well as the US, to start seeing some declines. It puzzles me as to why people think it's such a shocking event, because these are things which we are familiar with and we've read about booms and bust cycles. Anything can trigger it. And if you go back into history and see how previous cycles were triggered, you'd see that the smallest of smallest things can create a cascading effect. So it's hard to pinpoint, while the big things which people thought would trigger something didn't trigger something. So us sitting here, it's almost impossible, or it is impossible for us to tell you that, this one event is going to trigger something. But you should know that cycles do act cyclically, and you will end up seeing tougher times ahead for the market as well. And this is a guarantee.
So what do you learn from this? What do you need to do from this? Well, what you learn and do from this is like what Anand has always been saying. If you see value, keep investing in Tiffin coffee ranges, as he says. When you see a value, companies which are there in your list and you've been tracking for some time and it appears to have come into value, then enter the market in Tiffin coffee ranges. Tiffin coffee ranges means small amount of capital you're willing to lose, which you're willing to take a risk on. So keep that in mind. That would be our advice, even in these kind of situations. Even yesterday, when the market was swinging wildly, we did get onto our other social platforms and did advise you guys to take it slow, not to get overexcited, especially when you see drops of 5-6% on companies you've been waiting to enter for a long time. Even then, take it slow. Because opportunities, like Sashwath says, will come because this is cyclical in nature. The cycle will continue pedaling out. The American elections is still almost 100 days away. We do not know what's going to happen there. What's happening in the Middle East with Iran, we have no idea, and what plays out there. So this is all forgetting what's happening in Europe. Europe is not doing very well in entirety, and even single countries are not doing well. We've spoken in many videos about this, like Germany, France. So keep all this in mind and move slowly when you see opportunities. Don't get eager and don't get excited when these opportunities do open. And of course, if you see Warren Buffett getting rid of Apple, he has his reasons. If he's getting rid of Bank of America, he has his reasons. Do not look at other investors and try to copy. You stay in your...
On this one point alone, in 2013, when he started buying Apple, since then, he's made over 40 times his money. So for him to take a little bit of that money out is nothing. I mean,
correct.
Yeah.
And he sees things in a different level. He's sitting at $200 billion plus reserves. He can do what he wishes. And his timelines and everything are very different compared to you. So don't look at a big investor and think, oh my God, he's doing this, so I must also do this. I must also sell. If he's selling, there's something wrong. He's not selling something because something is fundamentally wrong. He's selling for other reasons. And Anand does explain this into videos saying why he's selling and what is happening. But you guys seem to miss it sometimes and panic. And a lot of you do message saying, I have Apple or I have Bank of America. What should I do? What should I do? Remember why you bought those shares to start with. Is what I keep refraining to, coming back to, saying why we started this whole journey.
So thank you for watching this video. If you liked it, please hit the like button. Please subscribe to our channel if you haven't already. Hit the bell icon to get notified for when we upload. Finally, if you have any opinions, any comments, any feedback you want to give us, please do leave it in the comment section below. We do make it a point to read your comments. We thank you again for joining us on Be Rich.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.